Welcome back to Stocks and Trades channel. We provide easy to digest information in short videos about stock market investing, personal finance, money saving, and building wealth. Our content is designed to help you achieve financial freedom sooner. Today's video will provide news, insight, and investment suggestions on the week ahead. We'll analyze 2+1 stocks to watch this week and some others that will be volatile. So, let's begin. Disclaimer. All trading involves risk. Only risk capital you are prepared to lose. Past performance is not an indication of future results. This content is for educational or entertainment purposes only and is not investment advice. The slightly positive overall results that the major U.S. stock indexes posted masked what was otherwise an unusually choppy week. After a rally in the final hour of trading on Friday, the Dow and the S&P 500 added around 1% for the week. The Nasdaq eked out a tiny gain. As of Friday, fourth quarter profits at companies in the S&P 500 were expected to increase more than 24%, based on companies that have reported so far and forecasts for firms that haven't yet released earnings. That's up from the 21% rise that had been projected at the end of December. As expected, U.S. Federal Reserve policymakers signaled that they remain on track to begin lifting short-term interest rates at their next policy meeting in mid-March. The Fed didn't indicate how many additional increases it expects this year as it tries to prevent a further surge in currently high inflation. The International Monetary Fund lowered its forecast for global economic growth this year, citing uncertainty about the pandemic, inflation, supply disruptions, and U.S. monetary policy tightening. The IMF now projects global GDP growth of 4.4%, down a half percentage point from its earlier forecast, mainly due to growth downgrades for the United States and China. Our first stock type is dividend earning stocks. These are a great way to earn passive income. This week's suggestion is Main Street Capital Corporation, with ticker symbol MAIN. Main Street Capital Corporation is a business development company. The fund focuses on providing customized debt and equity financing solutions to lower middle market companies. The company's portfolio investments are made to support management buyouts, recapitalizations, growth financings, refinancing and acquisitions of companies' annual revenues between $10 million and $150 million. It offers financing alternatives to entrepreneurs, business owners and management teams. The company was founded in 2007 and is headquartered in Houston, Texas. Dwayne Hyzak has been serving as the Chief Executive Officer since November 2018. Some technical analysis data shows that Main Street Capital's return on equity is 19.9%. Its average volume is about 313,000, its market cap is $2.99 billion, its beta is 1.44, its PE ratio is 9.28, its PEG ratio is 2.05 and its EPS is $4.63. Our rating is 9 and we consider this stock as a moderate buy. Based on experienced analysts offering 12-month price targets for Main Street Capital in the last 3 months, the average price target is $46. With a high estimate of $48 and a low estimate of $43. With current price at $42.98, this would mean about 7% average profit over the next year. Main Street Capital pays an annual dividend of $2.60, which amounts to a dividend yield of 6.04% and a dividend growth of 0.81%. The ex-dividend date is the 1st of February, so buying a Main Street Capital stock by then will pay you 22 cents on 15th February. Main Street Capital's fundamentals appear to be heading in the right direction as the economic reopening progresses due to society better learning how to live with COVID-19. As a testament to its quality, Main Street Capital has never reduced its monthly dividend paid to shareholders since going public in 2007. Since that includes the Great Recession and the COVID-19 pandemic, it's a rather impressive track record. In fact, Main Street Capital's dividend has been raised 95% from the 33 cents per share paid in the fourth quarter of 2007 to the $0.645 per share that will be paid in the first quarter of this year. Main Street Capital boasts a high dividend yield that can turbocharge an income portfolio. But it's just as important to note that this passive income appears to be dependable based on the stock's improving fundamentals, manageable payout ratio, and strong track record. Income investors looking for a steady monthly dividend payer would do well to consider buying Main Street Capital. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our second stock type is growth stocks. A growth stock is a share in a business that's shown above average earnings and has the potential to grow faster than the overall economy. This week's suggestion is Boyd Gaming, with ticker symbol BYD. Boyd Gaming Corporation engages in the management and operation of gaming and entertainment properties. It operates through three segments: Las Vegas Locals, Downtown Las Vegas, and Midwest and South. As of March 2021, the company operated 28 gaming entertainment properties located in Nevada, Illinois, Indiana, Iowa, Kansas, Louisiana, Mississippi, Missouri, Ohio, and Pennsylvania. Its portfolio includes hotels, casinos, breweries, resorts, and spas. It also engages in owning and operating a travel agency. The company was founded by William Samuel Boyd and Sam Boyd in 1975 and is headquartered in Las Vegas, Nevada. Keith Smith has been serving as its president since 2005 and chief executive officer since January 2008. Some technical analysis data shows that Boyd Gaming's return on equity is 33.5%, its average volume is about 1.07 million, its market cap is $6.61 billion, its beta is 2.06, its PE ratio is 15.37, its PEG ratio is 0.85, its EPS is $3.83, and its asset growth is -1.03%. Our rating is 10 and we consider this stock as a moderate buy. Based on experienced analysts offering 12-month price targets for Boyd Gaming in the last 3 months, the average price target is $80.40, with a high estimate of $94 and a low estimate of $70. With current price at $58.88, this would mean a 36.55% average profit over the next year. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Our third stock type is blue chip stocks. These are typically large, well-established and financially sound companies that have operated for many years and that have dependable earnings, often paying dividends to investors. This week's suggestion is Home Depot, with ticker symbol HD. The Home Depot Incorporated is the largest home improvement retailer in the United States, supplying tools, construction products, appliances, and services. It operates the Home Depot stores that sell various building materials, home improvement products, building materials, lawn and garden products, and decor products, as well as provide installation, home maintenance, and professional service programs to do-it-yourself and professional customers. In addition, it provides tool and equipment rental services. The company primarily serves homeowners and professional renovators, general contractors, handymen, property managers, building service contractors, and specialty tradesmen, such as electricians, plumbers, and painters. It also sells its products online. As of August 2021, the company operated 2,298 Home Depot retail stores in all 50 states, the District of Columbia, Puerto Rico, U.S. Virgin Islands, Guam, 10 Canadian provinces, and Mexico. The company was founded in 1964 and is headquartered in Atlanta, Georgia. Craig Menear has served as Home Depot's chief executive officer since November 2014 and is its chairman since February 2015. Some technical analysis data shows that Home Depot's return on equity is 782.1%, its average volume is about 4.15 million, its market cap is $382.76 beta, its beta is 0.99, its PE ratio is 24.51, its PEG ratio is 1.81, its EPS is $14.96, and its return on capital is 29.5%. Our rating is 10 and we consider this stock as a strong buy. Based on experienced analysts offering 12-month price targets for Home Depot in the last 3 months, the average price target is $427.95, with a high estimate of $470 and a low estimate of $380. With current price at $366.54, this implies a 16.75% upside potential over the next year. 2020 was an especially fruitful year for the company, as shoppers staying home spent their money on home improvement, and Home Depot's strong digital program made it easy to shop online. It was also considered an essential store that was allowed to stay open during lockdowns, and 2020 sales increased 20% year over year. Sales growth has decelerated since then, as expected, but it's still strong. In the 2021 third quarter, sales increased 10% year over year. Demand remains strong, and the company has been able to meet it despite supply chain disruptions. Management is looking toward the future, upgrading its systems to handle omnichannel shopping. 55% of online orders in the third quarter were fulfilled in stores, and Home Depot is testing productivity enhancements, such as store-specific assortments, to provide a better shopping experience for customers. Investors can expect many years of growth from Home Depot. The above analysis is not exhaustive and just presents you some important insights. We suggest using this analysis and carry out your own detailed research before taking a decision to open any position. Next week, many companies are going to release their earnings reports, which is one of the most potentially volatile times of the year for equities, and if we are not careful enough, we could put our entire portfolio at risk. Companies may announce earnings or losses and stock prices may go up or down significantly. For this reason, we suggest that you avoid or carefully consider opening a position for the following stocks during next week, and wait to evaluate the earnings announcement before deciding to invest. NXP Semiconductors and AGNC Investment Corporation will release earnings on Monday 31 January. Alphabet, ExxonMobil, Alibaba, PayPal, UPS and Starbucks will release earnings on Tuesday 1 February. Meta, AbbVie, Thermo Fisher Scientific, Novartis, Sony and Waste Management will release their earnings on Wednesday 2 February. Thursday 3 February will be the most popular day of the week as Amazon, Eli Lilly and Company, Merck, Royal Dutch Shell, Unilever and Ford Motor Company among others will release their earnings on this day. Finally, Bristol Myers Squibb, Sanofi, Ubiquiti, Aeon and Tata Motors will release earnings on Friday 4 February. Watch these stocks' prices carefully and think twice before making any decision. Next week will not be that popular among dividend stocks, but we have some interesting options to suggest. Monday 31 January is the ex-dividend date for Bank of Montreal, Realty Income Corporation, Hasbro and Aon. Tuesday 1 February is the ex-dividend date for Main Street Capital Corporation and Sensient Technologies. Wednesday 2 February is the ex-dividend date for Graham Holdings Company and Valero Energy Corporation. Thursday 3 February is the ex-dividend date for Norfolk Southern Corporation, Costco and MPLX. Finally, Friday 4 February is the ex-dividend date for Magellan Midstream Partners, Citigroup, Intel and Xilinx among others. Be sure to buy any of the above stocks before the market closing of the ex-dividend's date previous day to benefit from the dividend payment. If you find this video useful, please like it, leave your comment below, share to a friend and subscribe to our channel. See you next time.